Order block. You've probably heard this term countless times, but here's the reality. Most traders who believe they understand order blocks are actually losing money using them. And the reason is simple. They don't know how to correctly identify a true institutional order block or how to use it effectively in real market conditions. Today, we're not just defining what an order block is. We're going to break it down into a clear, step-by-step framework that you can actually use to build a profitable trading strategy. Welcome to Graph Insight. Order blocks represent specific price zones where large institutional traders executed significant buy or sell orders. These zones are areas where big players accumulated their positions before a strong displacement move. In a bullish environment, a bullish order block is typically the last bearish candle before a powerful upward move that breaks structure. In a bearish environment, a bearish order block is the last bullish candle before a strong downward move that forms a break of structure. Understanding this foundation is essential before moving on to validation criteria. The first and most powerful confirmation of a valid order block is the liquidity sweep, also known as the takeout. Here's how it forms. You observe price moving downward, forming several consecutive bearish candles. Then something important happens. The final bearish candle breaks the low of the previous candle and immediately reverses upward. This move, taking out the prior low, is the liquidity sweep. It means price intentionally dipped below that level to trigger the stop-loss orders sitting under the previous candle's low. This is not random. Liquidity sweeps are deliberate actions by institutional traders to collect liquidity so they can fill their large buy or sell orders without causing slippage against themselves. The second key confirmation of a valid order block is the presence of imbalance, also known as inefficiency. Immediately after the liquidity sweep, price should reverse aggressively and move upward with clear impulsive strength. When price accelerates this fast, it creates an imbalance, a zone where buying and selling pressure were not equal. On the chart, this imbalance appears as a fair value gap, an area where one or more candles do not overlap each other. This gap represents a moment where institutional traders executed such a large volume of orders that price had no time to retrace or rebalance, and it dramatically increases the probability of a strong reaction when price returns to the zone in the future. The third and final confirmation of a valid order block is that it must remain unmitigated. This means that after the order block is formed, price has not yet returned to this zone to retest it or trade through it. A mitigated order block no longer represents unfilled institutional interest. It becomes significantly weaker and should not be relied on for future entries. Now let's analyze several different situations within a bullish market context to understand how order block exceptions work in real price action. In the first scenario, we observe price declining through 3 consecutive bearish candles. The final bearish candle performs a clear liquidity sweep, taking out the previous low and immediately signaling potential reversal. However, we also notice that no imbalance forms above this candle. In other words, the second validation rule is not met at this level. In this situation, we do not define the order block based on the liquidity sweep candle. Instead, we extend the order block boundaries to include the next candle. When we analyze that next candle, we can clearly see imbalance forming above it. This displacement provides the missing institutional confirmation, allowing us to classify this order block as valid despite the initial absence of imbalance on the sweep candle itself. In the second scenario, we again observe a short-term bearish move composed of 3 bearish candles, with the final candle performing a liquidity sweep. However, in this case, the wick of the third candle drops directly into the potential order block zone, effectively mitigating it. This interaction removes the unmitigated condition and significantly weakens the zone. Because the order block is mitigated during its formation, we must classify it as invalid and avoid trading from it. In the third scenario, after a bearish move, price forms a long-legged doji candle, signaling hesitation and a potential shift in control. Following this candle, price reverses sharply upward. In this case, we clearly observe a strong imbalance above the reversal, and price does not return to mitigate the potential order block. The absence of mitigation combined with clear displacement gives us strong confirmation that this order block is valid and institutionally supported. Now let's break down several entry models that can be used after identifying a valid order block. All of these entry models follow the same core principles, but they mainly differ in their risk-to-reward profile and level of confirmation. The first entry model is the most aggressive approach. In a bullish order block, a buy limit order is placed at the level of the upper wick of the candle that defines the order block boundaries. The stop loss is placed just below the lower wick of the same candle, adjusted by the spread. This model offers the earliest possible entry and the best potential risk-to-reward ratio, but it also comes with a higher chance of being stopped out if price slightly overshoots the zone. It is best suited for strong, clean order blocks with clear institutional confirmation. The second entry model is slightly more conservative. In this case, the buy limit order is placed at the upper level of the candle body that defines the order block, rather than the wick. The stop loss is placed in the same way as before, just below the lower wick adjusted by the spread. This approach reduces the likelihood of premature stop-outs while still maintaining a favorable risk-to-reward ratio. It balances early participation with improved confirmation. The third entry model is one of the most optimal and widely used approaches. Here, the buy limit order is placed at the midpoint of the order block zone. The stop loss again remains just below the lower wick of the order block candle, adjusted by the spread. This model provides the highest probability of execution and stability, although it slightly reduces the risk-to-reward ratio compared to more aggressive entries. It is particularly effective in volatile conditions where deeper retracements are common. Choosing the right entry model depends on market conditions, the quality of the order block, and your personal risk tolerance. The stronger and cleaner the order block, the more aggressive the entry model you can justify. In weaker or more volatile environments, conservative entries offer greater protection and consistency. Now let's apply our knowledge in a real market environment. Here we are looking at the 15-minute chart of the US dollar against the Japanese yen. The first thing we clearly identify is a bullish trend, confirmed by price breaking above the previous major high and forming a valid break of structure. The order block itself is defined by a very clear hammer candle, which signals strong rejection of lower prices and marks the point where institutional buyers stepped in. Above this order block, we can clearly observe the formation of imbalance, confirming strong bullish displacement. Importantly, price did not return to mitigate this order block, which keeps it valid and unfilled. After the first break of structure, price performs a healthy pullback and then forms another break of structure, further confirming bullish continuation and strengthening the external structure. Following this second break of structure, price retraces downward and forms a change of character by breaking an internal low. This change of character does not signal a trend reversal, but rather a temporary internal shift. During this retracement, price returns into the bullish order block and fills the buy orders resting inside the zone. Immediately after this mitigation, price reacts aggressively to the upside, producing a strong impulsive move. This final expansion confirms that the order block was valid, the imbalance played its role, and the change of character acted as an entry trigger rather than a reversal signal. This example clearly demonstrates how bullish structure, break of structure, imbalance, order blocks, and change of character work together in real market conditions to create high-probability trading opportunities. In this video, you've seen that order blocks are not random candles or magical zones. They are the footprint of institutional activity, and they only work when they align with structure, liquidity, imbalance, and mitigation logic. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video, subscribe to Graph Insight, and let me know in the comments which concept you want me to break down next. I'll see you in the next video.